studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Before a corporation can prepare a T2 tax return, it must first build a solid accounting foundation. That foundation is the journal entry. Many new tax preparers focus on tax slips, tax schedules, and tax calculations. But in reality, every number that eventually appears on a corporate tax return begins with an accounting entry. Think of the process like building a house. The foundation of the house represents the journal entries. Every investment transaction, whether it is interest income, dividend income, a capital gain, or a mutual fund distribution, must first be recorded through a journal entry. Once the journal entries are recorded, they flow into the general ledger. The general ledger then becomes the source for preparing the corporation's financial statements. Those financial statements produce the information reported on Schedule 100, which contains the balance sheet, and Schedule 125, which contains the income statement. Finally, those schedules flow into the T2 corporate tax return. Notice how everything depends on the foundation. If the journal entries are correct, the accounting records are correct. If the accounting records are correct, the financial statements are accurate. And if the financial statements are accurate, the corporate tax return can be prepared correctly. But the reverse is also true. If the journal entries are wrong, every step above them becomes unreliable. Incorrect journal entries lead to incorrect accounting records. Incorrect accounting records lead to incorrect financial statements. And incorrect financial statements lead to an incorrect T2 return. That can result in overstated income, understated income, tax errors, reassessments, penalties, and unnecessary problems for both the accountant and the client. This is why experienced tax preparers never start with the tax return. They start by understanding the accounting records. The key lesson from this slide is simple. Corporate tax returns are built from financial statements. Financial statements are built from accounting records. And accounting records are built from journal entries. In other words, journal entries are the foundation of corporate investment income reporting. Everything else is built on top of them. One of the most important responsibilities of a corporate tax preparer is correctly identifying the type of investment income that has been earned. At first glance, investment income may seem simple. Money comes in, and income is recorded. However, different types of investment income have different tax treatments, different reporting requirements, and often require different journal entries. That is why identifying the income type always comes before recording the accounting entry. Let's start with interest income. Interest income is commonly earned from GICs, bonds, savings accounts, and similar investments. From an accounting perspective, it is usually straightforward. Cash increases, interest income is recognized, and the income is generally fully taxable. Next, we have eligible dividend income. This type of income is often received from Canadian public corporations, such as banks, utility companies, and other publicly traded companies. The accounting entry may look similar to interest income, but the tax treatment is completely different. Because of this, dividend income must be identified and recorded separately. Now let's look at mutual fund distributions. This is where many new tax preparers encounter challenges. A mutual fund distribution may appear as a single amount on an investment statement, but that amount can actually contain multiple income components. It may include interest income, dividend income, capital gains, foreign income, or return of capital. Until the T3 slip provides the detailed breakdown, the true nature of the distribution may not be known. That is why mutual fund distributions often require additional analysis before the journal entry can be completed accurately. Next, consider capital gains. When an investment is sold for more than its adjusted cost base, a capital gain is created. The accounting entry is different because it involves both the investment asset and the gain realized on the sale. From a tax perspective, only a portion of the capital gain is included in taxable income, making its treatment different from interest or dividends. Finally, corporations may earn foreign investment income. These investments often introduce additional considerations, such as foreign tax withholdings and foreign tax credits. Again, proper classification becomes essential. A useful way to think about this process is the air traffic controller shown at the bottom of the slide. Just as an air traffic controller directs different aircraft to different runways, an accountant must direct different types of income to the correct accounting treatment. Every income type follows its own path. The key lesson from this slide is simple. Before recording any investment income, first determine exactly what type of income it is. Once the income has been properly identified, the correct journal entry, tax treatment, and reporting requirements become much easier to apply. Accurate classification is the first step toward accurate accounting records, accurate financial statements, and ultimately, an accurate T2 corporate tax return. Now let's look at two of the most common mistakes made when recording investment income in a corporation. These mistakes may seem small, but they can have a significant impact on financial statements, tax calculations, and the accuracy of the T2 return. Let's start with the first mistake: double counting income. Imagine that throughout the year, the bookkeeper has already recorded interest income as it was earned. For example, the corporation earns $5,000 of interest income, and the appropriate journal entry has already been recorded in the accounting records. Everything is correct so far. Then tax season arrives, and the corporation receives a T5 slip showing the same $5,000 of interest income. A new tax preparer might think, I need to enter the T5 income into the books. If that income is recorded again, the corporation now shows $10,000 of interest income instead of the actual $5,000 earned. The result is overstated income, overstated taxes, and inaccurate financial statements. This is why one of the most important questions a tax preparer should ask is, has this income already been recorded through bookkeeping? If the answer is yes, it should not be recorded a second time. Now let's look at the second mistake: ignoring reinvested distributions. This commonly occurs with mutual funds. Suppose a mutual fund reports a $1,000 distribution. Instead of paying cash to the corporation, the fund automatically reinvests the distribution by purchasing additional units. Many beginners mistakenly assume that because no cash was received, there is no income to report. However, that conclusion is incorrect. A reinvested distribution actually represents two separate transactions. First, the corporation earns investment income. Second, that income is immediately used to purchase additional investment units. The income still exists. The investment balance also increases. Both effects must be reflected in the accounting records. That is why two journal entries are typically required. One entry records the income that was earned. The second entry records the purchase of the additional investment units. If either part is ignored, the accounting records become incomplete. Income may be understated, investment balances may be incorrect, and the resulting T2 return may not accurately reflect the corporation's financial position. The key lesson from this slide is simple: avoid recording income twice, and never assume that income does not exist simply because cash was not received. Remember this important rule: reinvested distributions create two things at the same time. investment income, and additional investments. Understanding these two common mistakes will help you avoid some of the most frequent errors encountered in corporate investment accounting and ensure that the financial statements and T2 return are prepared accurately.